Good morning and welcome to our special US earnings season preview, and it's the time for Wall Street really to kick off the Q3 earnings season this week. Banks get things going with the likes of Wells Fargo, Citigroup and others as usual unofficially kicking off earnings season. I mean, we've already had 20 or so companies reporting on the S&P 500, but this is the week in which we expect the big numbers to start coming through. So some significant earnings coming up. We'll go into those in a bit more detail in a moment. But just to recap, Q3 saw the big indices up 1.2%. The Nasdaq also up 1%. Small caps though were down. The Russell 2000 falling by 2.5%. It was a quarter that had been marked by the Federal Reserve cutting rates amid real ongoing uncertainty around trade. We've obviously in the last couple of days had Donald Trump talking up this trade deal, and then in the last hour China saying that it needs more talks before it will sign the trade deal. And it's not even much of a deal. It's committing to a few increases in agricultural product buying, and the US delaying tariffs for some period of time. So nothing particularly significant, and even then China's saying that it's not it still needs more time to go through these. But back to earnings. So we've had the Fed obviously being front and center, expectations that the Fed will cut rates at the end of this month, and trade of course remains the big unknown, the dark cloud over which the market is trying to operate. But earnings come back into focus this week. We have seen, of course, also a bit of a rotation from growth into value. These sectors have not been so vulnerable. Of course, they're not the sort of vulnerable sectors in a downturn. So we've seen real estate investment trusts, utilities and consumer staples best performers on a year-to-date basis. More cyclical, pro-cyclical sectors like energy, financials, materials have been lagging behind so far. What we're not sure whether this will continue. I think ongoing uncertainty around trade should mean that trend does continue though. The S&P 500 reported a decline in earnings of 0.4% in Q2. That was off the back of a similar drop in Q1. So we've had back-to-back quarters of earnings declines, earnings per share declines. That is an earnings recession, and we expect Q3 to deliver a similar number. The FactSet data suggests a 4% decline in earnings. But when you factor in the fact the propensity for companies to beat expectations, it's maybe looking more like a 0.1% drop. Last time in Q2, 75% of S&P 500 companies beat their earnings expectations. So that's the setup. I think also you've got to consider the S&P 500 is currently on a forward PE of 16.5. That's above the decade average of 14.8. But it's behind the 5-year average of 16.6. So we're sort of in the midpoint. I think really what we need to see is some real clarity now from the earnings. Are we seeing a sort of longer term drag on earnings, or is this just simply a reflection of the big increase in earnings that we saw last year because of the tax cuts? So is essentially flat, is flat earnings actually pretty good, because really we had a big bump up in earnings last year, and so if they can keep that as flat this year, then we're doing pretty well? Or are we seeing a material decline in earnings as the global economy slows down? And what do executives think about what will happen over Q4 and then into Q1 of 2020? So banks kicking things off. Financials kicked off. They had a 4.5% gain in September. Year-to-date gains of 12% lag the broad market. I think really the big focus is going to be on net interest income. The Federal Reserve has been cutting rates. Back at the end of last year, October last year, Jamie Dimon was talking up the prospect of, he's the CEO of JP Morgan, of course, he was talking up the prospect of 4% US 10-year Treasury yields. Now we're dealing with 1.5% 10-year Treasury yields, the big gap there in versus expectations, and that's been hitting net interest income. And now JP Morgan reports this week, tomorrow 15th, expected to deliver EPS of $2.45. In Q2 net income was up 16%, and EPS beat the $2.50 expected with $2.82, and that was up from $2.29 the year before. So Jamie Dimon saying in the early September saying that he expects full year 2019 net interest income down $500 million from the previous guidance. So they've been cutting the guidance on net interest income, and that's just putting more and more pressure on cost-cutting parts of the business. Citigroup also posted decent numbers in Q2. It reports on Tuesday as well. EPS of $1.95 against the $1.80 expected, but that was largely because of the IPO of its bond trading platform TradeWeb. So EPS was actually $1.83 if you strip that out. Q3 we're expecting EPS growth of 13% at $1.97. Revenues expected to grow a little less than 1% at $18.5 billion. The decline in trading revenue is probably the one that we saw in Q2 that we'll look to see if that continues. We've obviously had a bit of a nightmarish IPO season this year, so we'll see how that's been affected. But trading revenues were down 5%. If you exclude the TradeWeb IPO from the numbers, trading revenues were down 5%, equities down 9%, fixed income down 4%, investment banking down 10%. So some tough numbers there from the trading division. So net interest income, number to watch. Trading revenues also number to watch. Wells Fargo also reports this week. Lower net interest income again, and comments about higher expenses in the Q2 numbers were the big drag. EPS for Q3 seen at $1.20, and that's going to be up 5.3% year on year. On revenues expected to be down 5%. So the company's got a CEO now, but we'll look to see what the outlook is on net interest income. In September, the bank's CFO lowered net interest income expectations for the third time in 5 months. So banks really having to play catch up to the Fed cutting rates here. And then finally, we're looking at Netflix. It's also reporting this week. That's the chart up behind me. You can find in the key statistics data, so Traders 10, the analyst ratings, average price targets. We've had a couple of analysts recently downgrade the stock as the share price has really come off this year. But you can get that. Still a strong buy on the consensus expectation. Traders data, that's our positioning here with a client positioning showing still bullish as well. Financials, you'll find here forecast earnings per share. So that's for the upcoming quarter. So seen at $1 there. So Q2 net ads were down at 2.7 million versus expected 5 million. That's really one of the key numbers that we're looking at. Yeah, that's what the analysts have been talking up, is do we see a further decline in subscriber numbers versus expectations. 2.57 million versus 5 million expected was a big miss, and it also lost 100,000 subscribers in the US. But then alongside the subscriber data is fear of competition, and we're expecting some guidance maybe to reflect fears that the likes of Disney, Comcast and Apple TV are going to start to weigh in on Netflix earnings. EPS was up at 60 cents versus 56 expected, but that was not really a benefit to the company because of these subscriber numbers. Really, EPS numbers for Netflix are a bit of a not really something to look at in the same way as they are for banks or other companies. It's the subscriber ads that we want to see. We want to see stronger guidance there, and we want to see more confident outlook in terms of the competition. But as I say, analysts have started to turn a bit more downbeat on the stock. But that's it for the moment from us. There are more earnings coming up this week. IBM, American Express, Morgan Stanley. There's a lot more, so do check your earnings calendars. We will have more updates for you in due course as well. And if you've got any questions about earnings season, do send us those questions to x-ratemarkets.com, and we'll try our best to answer them for you. Otherwise, I wish you a good rest of the day. Thanks for watching.